Assalamu alaikum. Welcome to day 12 of 15 days division crash course of performance management, and the topic is advanced variances. Now I know how much a student loves variances in performance management. So I have included all the important variances that one might be tested in performance management. But if there are some variances that I've not covered here, please do cover them through revision kit questions. Now, starting with sales variance, very important variance, okay? Material mix and yield variances, other targets for controlling production process, planning and operational variance, modern manufacturing environment. So, what is variance first? Before talking about the types of variance, what is the definition of variance? Variance means when there's any difference between what you have budgeted versus what actually is happening. For example, you might have assumed sale to be 20,000, but actually sale was 15,000. There's a difference, right? Of 5,000. So that's an variance. But variance could be negative or positive, known as favorable variance or adverse variance. Favorable means it's good. For example, in terms of sales, you have expected less, but actually sale was more. It's a favorable variance. Adverse means unfavorable. Adverse means something which is not in your favor, it's against you. For example, cost, you have assumed the cost to be low, but actually cost was high, so it's an adverse variance. Okay, now there are types of variances. It could be in terms of cost or for sales. Now for sales variance is made up of two other variances. Okay, so both variances you have to calculate separately, then add them together, becomes total sales variance. The first one is in terms of price, because we all know total sale is calculated sale price into sales volume. So the two variances are sales price and sales volume variance. First, we'll deal with sales price variance. This is when your price differs. You budget something else, price actually comes to something else. Okay, so calculation unchanged. Calculate a separate variance for each product. Different product might have different prices. So you don't add all the product and then take the no. For each product, separate variance needs to be calculated based on price. Next is sales volume variance. This further is divided into two things. First one, sales mix and sales quality. Sales mix variance measures the impact on profit of a change in the sales mix of a product sold. And sales quality is, again, it measures the impact on profit of a different total quantity of product actually sold to budgeted. Uh, it's not sales quality, it should be sales quantity variance. I'm sorry. Okay. Now, so sales variance. Okay. There are formulas of variances which one needs to master at. You should know it. So first one is actual quantity sold into actual price. We are using the initials here. AQ, that is actual quantity. AP, actual price. So AQ, AP. Okay. Next, actual quantity into standard price. AQ, SP. Together this makes price variance. So if you want to know the price variance, it's the difference between these two. That means, see, when it's price, we are keeping the, if you see, it's AQ, we are keeping the quantity same because it's price. We are only changing the price. So actual price, standard price. So it's just not we are comparing price. No. Actual quantity into actual price, actual quantity into standard price. You understanding? So that's how we are calculating price variance. Now, the next two. Actual quantity sold into standard margin, budget quantity into standard margin. What are we doing here? Here the prices are same, but we are changing the quantity. Okay. So here together this makes volume variance. If you see, price we are keeping same, standard margin, only quantity we are changing because it's volume variance. We want to change the quantity and see. So this way, if you learn, it's easier for you to remember. In price, we change the actual standard price, keeping quantity same. In volume, we keep the margin same, that is standard margin. We change the quantity, actual and budgeted. Okay. Together, this two makes sales variance. Now, what is margin that you've used in the standard margin? Margin is contribution per unit. It would be contribution per unit if it's marginal costing. If it's absorption costing, it's profit per unit. So we still don't know. Examiner will tell you whether it is margin or profit. Now, coming to the next type of variance, materials mix and yield. This very frequently it comes, this variance. So it's useful if you produce this in a table form. So you have to be prepared to explain the meaning of each variance and also the possible causes of why that variance occurred. Basic idea is only use where material can be substituted for each other. Next, still do separate price variance for each material. Mix and yield are instead of separate usage variances. Now, so material usage is divided into material mix and material yield. Now, how do you calculate? This is how you calculate. Actual quantity into in actual mix, actual quantity in standard mix, but prices are standard. Then we have standard quantity in standard mix at standard price. So the first two makes up mix variance. Just check the first two line again. Forget about the third one. Quantity is same, actual quantity. Only the mix changes, actual and mix. Because it is mix variance. So in mix variance, you only change the mix. Quantity remains same. But the second and the third one makes yield variance. In yield variance, mix is standard, but you change the quantity, actual and standard quantity. I'm sorry, not the quantity. I have familiarized myself with sales variance, right? So that's why I'm repeating. It's not quantity, it is actual total Q input. Okay, the input. So in input, standard mix remains same, actual input and standard input. Mix makes yield variance. Now, if you go by tabular format for mix variance, this is how it is done. So material, there are two types of material, A and B. So first it is AQAM, actual quantity, actual mix, X, and actual quantity, standard mix. So we are keeping the quantity same, the input same, only the mix we are changing. Actual mix AM, second column, standard mix. So we are finding the difference between these two. Okay, for A. Same thing we are doing for B also. And price will be standard. So you find the variance for A. Separately we do for B and find the variance of B. So we check the difference between these two. The difference is the variance. Okay. So if you see the variance horizontally and vertically, you should get the same for the total variance that you are getting. If you add the variance of A and B vertically, that is downwards, and across, that is the change of AQM into AQSM, the total, you have to get the same variance. That cell has to get the same. This cell I'm talking about, the one which is mixing. Okay. Now, coming to yield variance, is the same thing. But this is SMSM. So input changes, AQ and SQ. Everything remains same. Price is standard and everything. You see? Everything else remains the same. The way we calculate. Now, possible reasons for this is, for mix, first we'll go through mix, then we'll go through yield. Okay. So as I told you, favorable and adverse. Favorable is good for you, adverse is not good for you. Okay. A favorable variance would suggest a higher proportion of cheaper material was used. You might say this is not good for me, right? Because in terms of quality it will suffer. But you see, if you are having a cheaper material, means in terms of price it will reduce for you, no? So it's good for you. That's why they are saying when you're using a higher proportion of cheaper material, gives you a favorable variance. And why do you think you might use a cheaper material? Could be, let's say, you have decided to cut the cost, or cheaper materials are available, or other expensive materials not available. Cost of other materials have risen, so it was decided to use less of the expensive material. Now, coming to yield. For yield, an adverse variance would suggest. What is the meaning of adverse variance in yield? It means less output has been achieved for a given input. That's adverse, it's not good, right? Because we always want to use less of input and achieve more of output. But if you are getting less output for a given level of input, it's an adverse variance. Okay. So, example, total input in volume is more than expected for an output achieved. That means input is more than output, which is adverse. This could be due to the following reasons. Maybe labor are inefficient. If labor are inefficient, they are going to produce less output with a given level of input. Next, they are going to waste. Materials are inferior. They are using cheaper mix with a lower yield. Bad choice. Now, other targets. So, other than variance also, there are other ways you can control in the quality. How? You can do quality measure. For example, you might have an aim to reduce the waste by a certain percentage, or yield by a certain percentage you might want to increase. Next, we might have average cost of input would be the target. Average cost of output. Average price achieved for finished products. Average margin. Percentage on time deliveries. Customer satisfaction ratings. Detailed time sheets. Percentage of ideal time. So you can concentrate on this other areas also. Now, planning and operational variances. The third type of variances that we are going to cover here. What is the meaning of it? You have to calculate the variance. We all know it's important. But you have to be able to interpret each variance also and discuss why a standard should be revised. You cannot keep the standard forever the same. You have to keep on revising it based on new information that you get. So, the original budget versus the revised budget together makes up planning variances. Why planning? Because your original budget, now you're changing your plan to a new budget. So, it is known as planning variances. And this is something uncontrollable. You cannot control it. Next, when you compare the revised budget with the actual result, it is operational variance, operating variance. This you can control. That's why it's controllable. The question is controllable. Now, advantages are variances are more relevant. Correct, no? Because more revised budget, better it is. Next, operational variances gives a fair reflection of the actual results received in the actual condition. Managers are more likely to accept and motivated by the variances. Emphasize the importance of planning. Analysis helps in the standard setting learning process. Now, disadvantages are establishment of ex post budget is very difficult. Once you have created a budget, again revising your budget, it's difficult in practice. And managers whose performance is reported to be poor using a budget, they are unlikely to accept this new budget. It is an extra administration work also. And the analysis tends to exaggerate the relationships of variances. It tries to show more importance that variances are interrelated. They might not be so. And poor performance is often excused as being the fault of a badly set budget. They try to blame that because the budget was badly set, that's why their performance is poor. And if you frequently demand to revise budget, it can result in bias. But there are some good reasons instead of the excuses to revise the standard. Number one, let's say you have changed one of your main material. You have to change the standard. Then suddenly the price increased of a material. Let's say the world market price increase. For example, for price like oil, coffee, there is a change in the working method. Okay. So which changes the direct labor hour also. Then unexpected change in the rate of the pay to the workforce. For example, government suddenly introduced a minimum wage legislation or something like that in the country. Now, you have to split the sales volume variances into two elements. Original budget into standard margin, revised budget sales. Same for the sales also we have to do. Okay. Original budget versus the revised budget sales. But margin is same, standard and standard. This makes up market size variance, which helps in planning. Because remember, planning means you are changing original and revised budget, keeping the margin same. So it talks about the size variance. Okay, when you compare your revised budget with the actual sales quantity, everything is standard margin only. We are only changing the quantity here. Original, revised and actual. Then it becomes market share variance, the operational. Okay. Now, planning and operating cost variances. So when you are applying planning and operating principles to cost variances, you have to take a care. Okay. Over volumes and flexing the budget. So examiner's approach for using the exam is to flex both original and revised budget to actual production level. Flexing means, see, when you have budgeted, you might have taken some quantity, right? Even that quantity is budgeted. But flexing means you are taking that quantity to the actual production level and changing the budget. That is the meaning of flexing. So examiner told you to flex both revised as well as the original budget. So for operational variances, the revised standard and the flex budget supersede the original standard. That means the flex budget will take over the original budget. Okay. Same for the revised also. The revised budget will take over the revised budget without flexing before for operational. Now, so original budget flexed, revised budget flex, and actual result. First two differences is planning, next two is operating. We know this. But this when it is cost, okay, you have to flex. Now we are coming to the last part, that is in modern manufacturing environment, how can you use variance and use of it? So first is TQM, total quality management. Okay. Here, if you see any modern manufacturing environment, okay, variance will not be so good because gone were the days when the cost was same, industry was stable, everything was produced in a continuous batches. Now, focus is there's a continuous improvement in quality. TQM focuses on continuous improvement in quality, productivity and effectiveness through what? Management focusing on both process and the product. So the features of TQMs are this. Okay. Recognition that quality is determined by customer requirement. Next, prevent error before they occur. Third, total quality in the design of system and product. Real participation of all employees. Commitment of senior management to the cause. Recognition of the need for continual improvement. All these features are there and TQM is there. Next approach is just in time. Now modern manufacturing environments, they do not keep everything in the stock. Now it's a pull based system. Based on the customer's demand, they are going to order stocks. Okay, that's why it's pull. It's not push based, it's pull based. Goods are only ordered when they are needed. So this eliminates the large inventories of materials and finished goods. Now, key characteristics of working JIT successfully are high quality. So they are also possessing TQM system. Next, speed. Speed is very high. Speed needs to be high in this because you have to meet customers' demand anytime. Reliability. Computer aided manufacturing technologies are there which will help you to do this. Then flexibility is there. Much small batches and automated techniques are used. Cost is low because of all of the above. If it's high quality, speed is there, reliability is there, flexibility is there, automatically cost will drive down. Now, relevance of variance analysis. So in this type of sector, how variance analysis could be relevant, we'll see. First, before environment was manufacturing, there was a manufacturing environment. So standard products were produced. Products were identical. Okay. That's why you can apply the standard product cost also because every product is same. But nowadays it's not so because we are making products according to our customers' demand. Products are more customized. So here you cannot apply the standard product cost. Next, standard cost became very outdated in a modern business environment. Third reason, it is also doubtful also whether you can use standard costing in the manufacturing environment or not because even manufacturing environment is automated now. Okay, so if you use standard costing, it is not going to give so much of value to a automated manufacturing environment. Standard costing. Standard costing means you are adhering to the present standard, preset standard. But this might be inconsistent with the concept of continuous improvement. If you want to continuously improve, just complying with the standard costing might not be consistent. Then we have ideal standards. So ideal standards are often used in variance analysis. Okay. So adverse variances have a different meaning than if the current standard was used. Because you are using ideal standard, not the current standard. Variance analysis, if you see, they are carried out on an aggregate basis. For example, you are using total material usage variance, total labor efficiency variance, right? But in a complex and a changing, ever changing business environment, they might need more detailed information so that effectively you can control the management. And the last point, variance analysis control reports are often made at the end of the reporting period to the manager. But in a modern business environment, they might require more frequent information on a real-time basis. So through all this, what conclusion can you come up to? The conclusion that I came up to is variance analysis is not so much of a use right now in the modern manufacturing environment compared to what it was before, right? Then the question comes, why are we even studying variances if it's not so? Because not all industries are modern. Not all industries have advanced so much. There are still some backward countries, some industries where variance analysis are still used. That's why. Now, from your questions that you have to go through our Romeo company, OBC, Rayshot, Glove company, Kappa company, Safe, Soap company, Medical Temp company. Thank you for watching and I will see you in the next. Till then, don't forget to subscribe to my channel if you haven't subscribed, and you can access these PPT slides from my channel from the About section. Scroll down and click if PM revision crash course and download all the PPT slide. Thank you.